Imagine waking up on Monday morning, looking at your retirement account and genuinely wondering if the global economy is just, well, collapsing.
Right, the tape is just flashing red everywhere.
Exactly. I mean, you're reading the headlines and it feels like the floor has completely fallen out. But you imagine waking up 4 days later to find out that your portfolio didn't just recover, it actually rocketed to an all-time record high.
Yeah, it's not hypothetical at all.
No, not at all. That is exactly the absolute whiplash of a week we just experienced on Wall Street, culminating today. So welcome. It is Friday, August 14th, 2026, and you are tuned in to the Bulls, Bears, and the Bill podcast. I as your lead macro anchor.
And I'm your chief growth strategist.
And today we are doing a massive deep dive into this August rebound because we have a mountain of information to get through for you today.
Oh, absolutely. The closing data, the sector rotations, and man, those after-hours earnings reports.
Yeah, they perfectly capture this dramatic end of the week. So our mission here is to decode the underlying macro shifts, right? Look at the staggering moves in tech and AI infrastructure and figure out what this critical pivot point means for the broader economy and, frankly, for you listening right now.
Because the numbers we're unpacking today, I mean, they aren't just abstract figures on a screen, they represent a fundamental shift in how capital is flowing globally.
Right. So let's start with the macro picture. Monday opened looking like a terrifying bear trap. And just to be clear for everyone, a bear trap is basically a sudden, sharp drop in the market that tricks investors into thinking a massive sell-off is happening.
Panic sets in.
Right. Everyone panics. They sell their positions to avoid further losses, and then, boom, the market instantly reverses and shoots higher.
Trapping all those people who sold at the absolute bottom,
Right.
Which is exactly what played out this week.
It's brutal. And to understand how we got from Monday's panic to Friday's euphoria, we have to look at the bond market. Because that is what gave institutional investors the giant green light to start buying.
Yep, the all-clear signal.
By the closing bell today, the S&P 500 hit a new record high right in the 5,680 area.
Wow.
And the Nasdaq, it surged over 5.1%, logging its best weekly performance of all of 2026.
And what makes this rally different from, what we saw earlier in the year is the breadth of it.
The participation, right?
Exactly. We are finally seeing broad market participation. It isn't just 3 or 4 massive tech companies dragging the entire market upward anymore. Small caps finally caught a bid, and the Dow Jones secured a positive weekly return as value stocks stabilized.
But the primary catalyst behind all of this action seems to be the 10-year Treasury yield. It just plummeted to a 15-month low. So unpack the mechanics here for us. Why is the 10-year yield dropping the magic key that unlocks a 5.1% surge in the Qs?
Well, because the 10-year Treasury yield is essentially, it's the gravitational pull on the financial universe.
Wow, okay.
It is the foundational benchmark for global borrowing costs. So when that yield drops to a 15-month low, the bond market is aggressively declaring a massive shift in monetary policy.
They're pricing in the Fed.
Precisely. They are officially pricing in the expectation that the Federal Reserve will implement its first rate cut in 4 years at next month's FOMC meeting.
The Federal Open Market Committee. The people in the room actually setting the dials for the economy.
Right. And for 4 long years, the Fed's prevailing narrative has been higher for longer. They kept borrowing costs painfully high to choke out inflation.
Yeah, again, it hurt.
It really did. But now the bond market is saying, look, the fight is over. Rate cuts are imminent. And that mechanism changes everything. Because when borrowing gets cheaper, it acts as rocket fuel for growth stocks, like the tech companies that make up the Nasdaq.
Okay, but why growth stocks specifically, though? Why does a tech company care more about interest rates than, a legacy bank or a utility company?
It all comes down to how they are valued. A growth stock is often a company whose biggest profits are projected to happen years down the road.
Right, future earnings.
Exactly. They rely heavily on borrowing money today to build the technology of tomorrow. So if borrowing money is incredibly expensive, the cost of doing business skyrockets, and those future profits look much, much smaller in today's dollars.
That makes sense.
But when interest rates drop, money gets cheap. Suddenly, funding their expansion is easy, and those future profits become vastly more valuable today. Value stocks, on the other hand, the traditional companies that make up the Dow Jones.
The blue chips.
Right.
Right.
They are usually established businesses generating massive cash flow right now. They don't rely as heavily on debt to grow, so they are way less sensitive to interest rate swings. And that's why the Nasdaq surged a massive 5.1% on the yield drop, while the Dow, it simply stabilized.
The higher for longer era is dead.
Okay, that makes sense. But I don't want to push back on this a little bit because there is another piece of macro data we really need to look at.
The Michigan print.
Yes, the University of Michigan consumer sentiment reading just came out, and it actually fell month over month to 69.1. Now, it beat expectations, and Wall Street is calling it a Goldilocks print, cooling enough to justify those Fed rate cuts, but strong enough to stave off the recession fears we had on Monday.
Right.
But I have to ask, is this just a market sugar rush? Are investors just eating a whole bag of candy because the Fed hinted at cheaper money? Or is this 15-month low in the 10-year yield a definitive, nutritionally sound foundation for a real rally? I mean, are they just hearing what they want to hear?
Honestly, it is the exact debate happening on trading desks right now.
Yeah.
But I would argue it is not a sugar rush, and here is why. You have to look at the mechanism behind that 69.1 sentiment reading.
The consumer makes up roughly 70% of the total U.S. economy. If that sentiment number was plummeting into the 50s, we would absolutely be in recession territory, and Monday's panic, well, it would have been totally justified.
Right, the floor would have actually fallen out.
Exactly. On the flip side, if the number was skyrocketing into the 80s, the consumer would be spending way too much, inflation would reaccelerate, and the Fed couldn't possibly cut rates.
They'd be trapped. They couldn't move.
Exactly. But 69.1 sits right in that Goldilocks zone. It proves the consumer is slowing down just enough to kill inflation, but not enough to trigger a recession. It gives the FOMC the exact data-driven cover they need to cut rates without looking like they are hitting the panic button.
Interesting. So the immediate jump in the Nasdaq might have a bit of a sugar high to it, sure, but the foundation is solid.
Yeah, the actual lowering of the 10-year yield based on tangible consumer data, that is a real structural change to the economic diet.
Okay, so the green light is real. The cost of capital is coming down. And with those dropping yields acting as rocket fuel, we have to pivot to the massive late session rotation we saw today back into semiconductors. Specifically, the absolute behemoth in the room, NVDA.
Oh, you really cannot talk about the market in 2026 without talking about NVDA. I mean, they are the engine of this current cycle.
Totally. And here is where it gets incredibly fascinating. NVDA closed at $225.30 today, but they don't even report their actual earnings until August 26th.
Right. We're still a couple weeks out.
Despite that, the options market is currently pricing in a massive 6.99% move on that exact earnings date. I mean, that is a $15.74 swing per share just waiting in the wings.
Let's break down what that actually means because, saying the options market is pricing it in can sound like Wall Street jargon.
Yes, simplify it for us.
The options market is essentially where traders place financial bets on future price swings. By looking at how much people are willing to pay for those bets, we can mathematically calculate exactly how volatile the market expects the stock to be. Pricing in a roughly 7% move on a company the size of NVDA is astonishing.
It's massive.
We are talking about hundreds of billions of dollars in market value swinging on a single day.
It really highlights just how much uncertainty and anticipation surrounds their every move. And we are seeing massive retail interest surging right now based on two very specific catalysts. First, the conditional H200 chip exports to China, and second, the launch of their new Rubin platform.
Right, the hardware updates.
But the headline that really stopped me in my tracks today happened in the financial sector late this afternoon. 6 major financial titans, we're talking massive global banks, finalized a $500 billion AI compute infrastructure financing platform with NVDA.
$500 billion. Just let that scale sink in for a moment.
$500 billion. And the stated goal is to mobilize third-party capital for enterprise AI buildouts. So the strategic shift here is profound. NVDA isn't just sitting in Silicon Valley selling chips anymore.
No, they are actively orchestrating the financing for the world's AI infrastructure.
Right. It feels to me exactly like a 19th century railroad company. They used to just manufacture the steel tracks and sell the locomotives. But now they've suddenly decided to start financing the banks that are building the actual towns along those tracks. They're basically funding their own customers to buy their own products.
It's a great analogy, and it speaks to the rapid maturation of the AI cycle. We have completely moved past the phase where, A tech startup buys a few hundred chips to experiment with a language model. We are now in the phase of sovereign AI.
Sovereign AI. Define that for us.
It means entire nations, governments, and the largest legacy enterprises on Earth are building localized, sovereign data centers to control their own artificial intelligence.
So it's not just big tech anymore.
Exactly. They aren't renting space in the cloud, they are building massive physical infrastructure. You are talking about data centers so incredibly large, they require their own dedicated power plants.
Right.
The capital expenditure, the upfront cash required to build that, is too large for even the biggest tech companies to handle out of their own pockets.
Right. So they need the massive banks.
Yeah.
But here is my question. Does this $500 billion financing deal fundamentally change NVDA's risk profile?
How do you mean?
Well, are they morphing from a pure technology innovator into a quasi-financial institution? Because if they are heavily involved in the financing of their own customers, doesn't that expose them to a massive amount of credit risk? Like, if these AI towns go bust, is NVDA left holding the bag?
I have to stop you right there because that is a very common assumption, but it entirely misses the structural brilliance of what NVDA just pulled off. Your railroad analogy is good, but let's tweak it a bit. Think of NVDA right now, not as a bank, but as a mortgage broker. By pulling in these 6 financial titans, NVDA has created what's called a syndicated risk pool.
A syndicated risk pool.
Right. NVDA is setting up the loan so the massive data center can be built, which ensures their chips are bought, of course. But the actual money and the devastating risk of default, well, that sits with the 6 big banks.
Oh, wow. So they get the sale, but they outsource the risk.
Precisely. They are the architect of the financing, but they are distributing the actual credit risk to the institutions whose core competency is managing that exact kind of risk. NVDA gets the revenue from the hardware sale without holding the bag if the client goes bankrupt.
That is brilliant.
It turns them into a market maker for the future of infrastructure. They are ensuring that the one thing that could permanently stall their growth, a lack of available, affordable capital for their customers, is completely removed from the equation.
They are essentially clearing the road ahead of them. And that aggressive financing push proves that immense real-world capital is flowing into this space, triggering a massive ripple effect across the broader tech hardware ecosystem.
Yeah.
It's not just NVIDIA winning in a vacuum.
The hardware trickle-down is very real.
Yeah, look at memory providers today. Companies like SanDisk saw double-digit weekly gains driven by fierce demand for AI-integrated hardware.
Well, that is a fundamental mechanical reality of computing. You cannot run these massive new AI models on processing chips alone. You need high bandwidth memory to feed the data to the chips, and you need an astronomical amount of it.
The physical plumbing of the entire internet is basically being upgraded. And it's not just happening in the public markets either. The private-to-public pipeline is running white hot right now. Just this afternoon, River AI announced a staggering $1.1 billion capital raise in the private markets.
So it's massive numbers.
Yeah, $1 billion to accelerate the development of their personal AI model. So we are seeing billion-dollar raises for software companies again.
Which proves that institutional investors are still willing to place massive, concentrated bets on the software and model layer, provided they believe the hardware infrastructure, the data centers NVIDIA's financing, will actually be there to support it.
Okay, so we've established the digital brain is getting funded, but then we get to the headline that reads straight out of a science fiction novel, and I really need your help parsing this one.
Let's hear it.
LG and NVDA announced today that they are co-developing a consumer humanoid robot, and they are targeting a release for 2027.
Yep, the big reveal.
This single news drop sparked a massive late afternoon IPO frenzy-style rally in humanoid robotic stocks today. The entire narrative being pushed on trading desks right now is that we are actively shifting from AI in our phones to AI walking around our living rooms.
It is the ultimate physical manifestation of the digital leaps we've been discussing.
Okay, I hear the pitch, but I have to admit, I am highly skeptical here. I am having severe flashbacks to the 2021 tech bubble. Are we really supposed to believe we are going to have consumer humanoid robots walking around our living rooms folding laundry in exactly 3 years?
It sounds crazy, I know.
Is this late afternoon robotics rally just peak froth returning to the market? I mean, is the LG and NVDA partnership concrete proof that Wall Street is officially pricing in tangible 2027 physical product cycles? Or is everyone just getting swept up in a really cool sci-fi press release?
I understand the skepticism, and honestly, normally I would agree with you. When you hear humanoid robot in 3 years, your brain applies the timeline of traditional manufacturing. You picture engineers building a robot, watching it fall over, tweaking a wire, and trying again for a decade.
Right, trial and error in a lab somewhere.
But that is the wrong lens to view this through. The underlying mechanics of hardware development have been radically, fundamentally compressed by AI simulation.
How so? Like, what's actually different now?
Well, NVDA has built virtual, physics-accurate environments. They don't have to build a physical prototype to see if it can walk. They can put a digital version of the robot into a virtual simulation and train it to walk, pick up a cup, or navigate a living room millions of times a day.
Oh,
The robot's AI brain learns from millions of digital mistakes in a matter of hours rather than physical mistakes over years.
so by the time they actually construct the metal and plastic, the brain already knows exactly how to operate the body perfectly.
Precisely. The trial and error is entirely digitized. Now, does an IPO frenzy-style rally in secondary robotics stocks indicate market froth? Absolutely. Markets always over-extrapolate the future in the short term. However, you cannot dismiss the partnership itself.
Because it's LG.
Right. LG is one of the largest consumer electronics and mass appliance manufacturers on the planet. This is not a trivial PR stunt. LG brings the global mass manufacturing scale and the appliance supply chains, and NVDA brings the digital brain and the virtual training environment.
That's a powerful combo.
It is. So while a 2027 timeline for a fully autonomous, do-everything robot in your living room might be aggressive, the market is accurately waking up to the beginning of a massive new hardware cycle. It's not just software running on a server anymore. AI is officially getting a physical body.
AI is getting a body. Wow. But, we just talked about how AI is getting a $500 billion digital brain and now a physical robot body. But here's the reality check. You cannot build a digital data center or mass-produce a robot body without concrete, steel, and logistical supply chains.
The real-world stuff.
Exactly. And that brings us to the most surprising headline of the week, which requires us to look at how the traditional blue-collar industrial economy is performing right now.
The old economy is proving remarkably resilient, and honestly, it's flying completely under the radar.
Resilient is the perfect word. Despite all this massive tech dominance and sci-fi robotics we just outlined, value stocks stabilized enough today to keep the Dow Jones essentially flat, but positive for the whole week.
Up 112 points today.
Right. And the absolute best example of this comes from the after-hours earnings highlights today. Ford Motor Company, ticker F, reported an incredibly robust Q3 net income of approximately $2.4 billion.
A very strong beat that caught a lot of analysts off guard.
Totally off guard. It sent their shares spiking 4.4% in late trading. But here is the mechanism that makes this so fascinating. The driver for Ford's massive profit wasn't flashy new EV tech. It wasn't self-driving software.
No, it's trucks.
Investors were specifically cheering for improved margins in their Commercial Pro division. We are talking about commercial work trucks and heavy-duty vans, fleet vehicles. So help me square this circle. Amidst a $500 billion AI financing deal and a frenzy over humanoid robots, a legacy automaker making diesel work trucks is quietly crushing earnings and spiking 4.4%. How do these two completely different economies exist side by side right now?
They don't just exist side by side, they are inherently and fundamentally connected. We often make the analytical mistake of separating the tech economy from the old economy as if they operate on different planets.
Right.
But think about the mechanism of what we just discussed in the previous segment. If a sovereign nation or a legacy enterprise is going to utilize that $500 billion NVDA financing facility to build a massive new AI data center, who actually builds the data center?
The blue-collar workers?
Exactly. You need electricians, plumbers, steel workers, construction crews, and massive logistical supply chains. And what do all of those crews drive to the job site every single morning? They drive commercial work trucks.
Wow.
Ford's Pro division succeeding is a direct derivative of AI infrastructure spending. Furthermore, when the 10-year Treasury Yield drops to a 15-month low like it did this week, it isn't just cheaper for a tech startup to borrow money. It suddenly becomes cheaper for a regional construction company to finance a fleet of 50 brand new Ford work trucks.
So it all ties back to the yield.
Always. The strength in Ford's commercial division is the physical confirmation that the capital from Wall Street is actually being deployed into the real dirt of the economy.
That is a phenomenal connection.
Yeah.
So the tech boom and the old economy resilience aren't contradicting each other at all. The tech boom is actively pulling the industrial economy forward, right alongside it.
You cannot build the digital future without the physical present. The fact that the Dow Jones and those value stocks are stabilizing right alongside the Nasdaq's 5.1% surge is arguably the healthiest signal the market could possibly send.
Because it shows real breadth.
It proves the broader economy is firing on multiple cylinders, not just the one cylinder marked artificial intelligence.
So what does this all mean for you, the listener, as we wrap up this incredible journey of a week? We started on Monday with a terrifying bear trap and genuine fears that the economy was stalling out and heading for recession. We ended with a Friday record high.
A total 180.
And it was all driven by three massive tectonic shifts we've unpacked today. First, the definitive end of the Fed's higher for longer era with that 15-month low in the 10-year yield. Second, a $500 billion structural shift in how the physical infrastructure of AI is being financed. And third, a remarkably resilient industrial base proving that real-world companies are still grinding out billions in profit.
It is a profound shift in the macroeconomic landscape, and the ripple effects matter immensely to the individual.
Exactly. Because this isn't just about Wall Street billionaires and Silicon Valley tech companies. That shift in the 10-year Treasury yield, that fundamental drop in the cost of global borrowing, it directly dictates the cost of your reality. It dictates the interest rate you will pay on your future mortgage, the financing rate on your next car loan, and the underlying valuation of your entire retirement portfolio.
When capital flows this violently and this quickly, it physically reshakes the economic ground we all have to walk on.
And as we've seen clearly today, that ground is evolving faster than most people can even track. Which brings me to one final provocative thought to leave you with, something to mull over as you digest everything we've covered in this deep dive.
This is the big question.
We spent a lot of time talking about the rapid speed of innovation today. We literally went from AI living exclusively inside text boxes on our computer screens to the reality of major tech and appliance companies co-developing physical humanoid robots for consumers by 2027.
Just 3 years away.
Right. So if the financial markets are already aggressively pricing in consumer humanoid robots for just 3 years from now, how much faster will the physical, tactile world around us change in the next 3 years compared to the digital-only software shifts we've experienced so far? The roller coaster isn't slowing down. The tracks are just getting built faster.
It's going to be a wild ride.
That it is. Thank you so much for joining us for this deep dive. You have been listening to the Bulls, Bears, and the Bell podcast.
Be sure to subscribe on Spotify or your favorite podcast app so you never miss an update when the market moves.
We will see you back here on Monday. Have a great weekend.